Hi, I'm Tom Lydon with ETF Trends here in Hollywood, Florida at the Inside ETF Conference. Here with Ed Rosenberg, head of ETF's American Century Investments, and Renee Cassis, ETF Portfolio Manager. Great seeing you guys.
Thank you for having us.
So let's talk about 2019. What do advisors need to be thinking about?
So I think advisors need to worry about the choppiness of the markets, right? As we're going forward, two things are driving the market right now. The main one is the Fed, right? That's the first thing. Are they going to raise rates? Are they not? We've talked about one rate raise this year potentially happening. Now it seems like the futures are predicting either not or late third quarter.
Yeah.
The second thing they need to worry about is we keep talking about this China trade deal. That will drive the market for a day or a week, but I really think that it's important to look for, because if it's going to happen, you can buy on, there's news that it's not, you can buy on a dip or potentially get ahead of it before it happens. But realistically, it's these rate hikes. They're really driving the market forward as we go. And I think you'll see choppiness the first half of the year. And as we get a better, clearer picture of what's going to happen, I think you'll see us smooth out in the second half of the year.
Renee, what do advisors do if they're going to follow that strategy that Ed outlined? How can they implement that?
Well, I think that portfolio construction is going to become a very, very key component to managing assets this year, especially this year. As Ed mentioned, with potential rate hike, can result in higher volatility in the market as people just are trying to figure out what's going on. I think that portfolio construction is going to become very important, and having components that can best respond to these these very quick changes in the economic environment is going to be very crucial.
So the average advisor and investor who's ETF centric has bought pure beta strategies that might have been cap weighted strategies, worked pretty well for a long period of time. How are they going to change? And you've got some tools that you might be able to talk about.
Yeah, so I mean, think of it from the perspective of how does your ETF adapt?
Yeah.
The products we've launched, we have 3 products that are index-based. We call them intelligent beta. We have a growth product, large cap growth, large cap value, and an international.
Yeah.
They're dynamic. They shift with markets over time. So if the market's favoring value, the product becomes more value weighted. As the market value comes out of favor and says, okay, that's not where the money's going, the fund shifts to a dividend focus, right? So it can shift back and forth and adapt throughout the market cycles. And so you can use products that you can own throughout an entire market cycle that are adaptive or dynamic in nature that go through. And if you look at our fixed income side, we have a corporate product as well as a tax-free muni product. Both of them will dynamically shift between allocations between investment grade and high yield. And they also can shift duration. So the PMs have the ability to be more precise with what they think is happening in the market as opposed to just following the market along.
Okay, and being a PM, is that based on your research, or is there more of a discipline inherent in that ETF that would have you make that shift?
So there is certainly a discipline. These are as these are index products.
Yes.
They are very systematic in nature.
Right.
But the fundamentals that go into the stock selection is very much comes from a long history at American Century of being able to identify good, strong, quality companies. So Ed mentioned this dynamic shift, for instance, between our value and income. The very first step is actually screen out a beta universe for stocks that have higher quality in nature. And by that I mean companies that have better profitability, more stable earnings growth, and good, strong management that's in place as well. So from there, once we sort of screen out the companies that have a lower score to our value metrics, from there we can start to look at companies that have better valuations, better dividend or cash yields, things of that nature.
Excellent. And if advisors wanted to find out more about these ETFs, AmericanCentury.com?
AmericanCenturyETFs.com, they can go to, yes.
Excellent. Gentlemen, thank you.
Thank you for your time.
Thank you.